Over the weekend, I'm going to pose a question. Is Warren Buffett calling for an earnings recession? Now, I was on a panel about a week ago at an event in Las Vegas, and I was asked if I could name a couple of things about the market today that keep me up at night. One of the items is the possibility that corporate earnings could go negative in 2023. Now, expectations halfway through 2022 were for more significant growth than we saw in 2022 in terms of earnings for 2023, but they have been taken down about 13% from that time. So let's quickly look at a table on the S&P earnings over the past 5 years, including current expectations from this year, 1 quarter in. As we can see here, 4 out of the last 5 years produced positive earnings growth. The roughly 15% drop that we saw in 2022 due to the COVID shutdown is kind of self-explanatory. And the jump in 2021, that almost 50% jump as the economy reopened, was off of a very low base and juiced by the stimulus spending and historically low interest rates at the time. Now, 2022 showed more modest growth, and the expectations for 2023 right now are relatively flat. Now, I said like in June of this past year, expectations were for more significant growth in 2023. So forecasts have been taken down roughly 13% over that time to where we look at flat expectations at present. But the potential for negative earnings growth as the economy weakens is real. Despite this, as we can see here, the index is up. The S&P 500 is up 7.7% year to date. And since it is up about 17% from its October 12th closing low, this comes against the possibility, like I said, the earnings growth could go negative in 2023, or at least on a quarter over quarter or year over year basis in some of the quarters in 2023. Now, Warren Buffett commented on the near-term general economic view he's getting from his conversations with key management of the businesses Berkshire owns or invests in over this past weekend at the annual shareholder meeting. Buffett stated, and I quote, "In the general economy, the feedback we get is that perhaps the majority of our businesses will actually report lower earnings this year than last year." He reflected on the widespread supply chain disruptions everyone has faced since the onset of the corona pandemic or the pandemic. He was quoted as saying it was an extraordinary period and that the period has ended. During that period, however, many companies, including those under Berkshire's umbrella, overordered and now sit on excess inventory that will have to be cleared out at more unattractive prices. So where does Buffett think the economy or the economic climate is today? For me, he's a great guy to ask this because he's speaking directly with CEOs of some very diverse businesses that he owns or are under his umbrella or he's invested in through Berkshire Hathaway. Well-known brands such as insurance giant Geico, BNSF Railways, Fruit of the Loom, Brennan's favorite, Precision Cast Parts, Benjamin Moore, Duracell, and Dairy Queen. At his annual shareholder meeting, Buffett added that it is a very different climate than it was 6 months ago, and where a number of our managers were surprised, some of them had ordered too much inventory, and all of a sudden it got delivered, and the people weren't in the same frame of mind as they were earlier. Now, I can pass along anecdotally as well that having interviewed 20 plus management teams over the past couple of weeks, I would second his comments. There is caution in the C-suite, which does not match the market rebound that we've seen to start 2023. Now, for the consumer struggling with inflation, the prospect for lower prices is probably welcome. It should be welcome. It's bad, however, news for corporate profitability, which could be bad news in the near term for the stock market. Now, Buffett went on to comment that we'll start having sales at places where we didn't need to have sales before. And that's in the businesses under his umbrella, under Berkshire Hathaway that they own. They're looking at sales in areas over the second half of this year where they did not have sales in the past. Now, near term, we see the potential for earnings expectations to be revised lower. I'll give you an example. After the early 2000s recession, quarterly EPS estimates were cut 5 consecutive quarters in a row by an average of 12% ahead of each earnings season. Estimates were slashed 6 straight quarters by an average of 20% following the global financial crisis more than a decade ago. Analysts are often just too optimistic. Meanwhile, estimates for the second half of this year still call for growth, and we've really only seen just kind of what I'd call a paper cut to the earnings estimates for the second half of this year in respect from these analysts. Now, for Q3 and Q2 2023 of this year and Q4 2023, analysts right now are projecting earnings growth of 1.6%. That would be Q3. And for Q4, earnings growth of 8.5%. So it's still growth they're projecting. Now, let's look at what we call the long term versus the short term. If we do see surprises to the downside, essentially, in terms of corporate earnings in the second half of 2023, it can provide you with opportunities. Many market participants look near term. The market reacts often irrationally in a manner if they're staring straight at the near term. Now, this is news on a daily basis. You can use this to your advantage. We are doing this right now, essentially building a book of 5 to 10 names that we want to invest in long term. While they may face short-term earnings pressure, the long-term prospects of these businesses are strong. What typifies these businesses as they are strong track records of growth here, strong management teams, good balance sheets, and we see a growth path ahead of them. If, as we expect to be the case in some of these names, the market overreacts to what is likely to be a near-term overall market shortfall in earnings, then we will take advantage of the declines and buy great businesses over the next year as they come what we would call on sale. Now, with a holding period looking of 3 to 5 years, and when we look back, having made these purchases at these opportune times, 5 years from now, we believe we'll be happy we decided to purchase these strong businesses with long-term views when others are selling with their short-term market view. So that's a short-term market view versus a long-term view and how you can take advantage of that in the market. Finally, I'd close with the long-term chart on the S&P 500. Over 150 years, this is the earnings growth that we've seen. The earnings growth trajectory is something we expect to continue with significant opportunities along the way. So I'm not betting against corporate earnings in North America over the long term. You can take advantage of some short-term volatility, and we expect to see that over the second half of this year. So guys, you got any comments on that?
Well, just a few things. I mean, one of the things is that I personally believe listening to conference calls, talking to management teams is really one of the best ways to get a pulse on what's going on with the economy, because these are the people that are essentially at the front lines, and you get a lot of really interesting information in terms of, you know, what direction prices are moving in. I mean, especially when it's an industry with a lot of different companies in it, you get a lot of different perspectives. There's always the possibility some management teams can be overly optimistic, but you also over time get a sense of how to detect that. And for the most part, you're going to get generally good information on what's happening in their respective industries and just the macroeconomy overall. So yeah, absolutely. I mean, most industries, most companies are expecting macroeconomic headwinds, so pressures. And of course, one of the reasons why companies built up inventory, it's normal for companies to build up inventory when the economy is really heated, because they want to make sure that they have enough product on hand to sell to customers to meet demand. But of course, one of the reasons why the inventory build happened in this cycle was because of the supply chain issues that we were experiencing. Now, those have largely been resolved now, but when companies had the opportunities to build up as much inventory as possible, they did it because at that time, they didn't know if they were going to be able to get more supply. And of course, costs for container shipping, for trucking, for anything was quite high, relatively speaking. So they were essentially building up inventory while they had the chance. Now those supply chain issues have been largely resolved. You have pressures on the macroeconomy. So yeah, companies have built up a lot of inventory, and that has to wind down. But once that does, generally speaking, then they start to build up their inventories again, and that's stimulus for the economy.
Yeah, and that's the environment that they're in. They're normalizing. We've seen, I mean, I saw a couple companies last week reported, significantly higher inventories than they have in the past. And, they built them up. And while many think they can get off those inventories in a satisfactory manner, there, if we do head into a weaker period, you can see them having to cut sale. I mean, Warren's talking about it right there. He's saying they're going to have sales where they haven't had sales in the past. And so it was an extraordinary environment. Now, if you're selling to those companies that have extra inventory, you're likely going to see some soft quarters coming up because they're going to sell off out of inventory rather than reordering. So it's something definitely to watch. The other thing is, like Aaron said, one of the best things to gauge the overall economy is interviewing these CEOs and management teams. I think one of the things that gives us good insight into the general economic environment is because we're not sector specific. Like there's many analysts out there that just cover one sector, whereas we're looking across, when we did 20 interviews plus, there's probably 2 or 3 in the same sector. Many of them are just in diverse sectors. So you may see some strength in one sector, but you can get a general flavor or feeling for where the economy is at any given point when you're interviewing that many teams. I think many analysts, fund managers do themselves a disservice by not actually talking to the investment or the management teams of companies that they're investing in. You want to read through the conference calls, you want to look at those, but actually talking to them, you usually get a little more insight than just reading through a conference call, particularly depending on the size of the business. Some of them don't have as much information out there. So always talking to them is something we like to do.
Yeah, there was one company in Vegas who essentially has a digital advertising platform, and Ryan did ask that, macro, are you guys seeing any slowdown? And they said that they haven't seen that slowdown yet. So it really depends,
Sometimes that's in their best interest, obviously,
and sometimes
to
that
say
is in
that.
their
So you have
best
to weigh
interest.
that as well, right?
For sure. And,
As
then we talked to another company, that essentially market makes for, industrial assets and whatnot. If a company wants to divest those assets, and, they're seeing strength as, there was increased or they have, excess capacity, I guess, that maybe won't be utilized, that they're going to sell off. So, yeah, it really depends. And that's the thing where, coming out of 22 calls, how do you balance it? Like Ryan said, there's really areas of, strength and weakness. And again, like you said, it's making sure that, they're giving you a good answer.
Yeah, and even like Brennan was pointing out there, in a down market, there is pockets of strength, right? Like he was talking about a company that's selling off industrial assets. Well, if you have a downturn in the economy, they get a hell of a lot more supply, and they're all about the inventory, the supply coming in and turning it over. So, you can find those areas. I mean, it's something that we've been searching for just over the past year, is companies that are recession resilient, if you do in fact go into one. And companies that can even benefit long-term from a recession. Because like I said in the slides there's long-term versus short-term. Even if a company takes a hit short-term, but they can benefit coming out because they have cash on their balance sheet, they can buy other businesses that get distressed, or they just have a benefit like Brennan was talking about, that or a business that benefits from a downturn. So, I mean, things that you can look at in a downturn. I wouldn't just run to the hills, not make any investments. There still are great companies out there that you want to look at. And when the markets are actually off or down, that is the time when you want to buy. You don't want to look away from your portfolio at those times. You want to look at it more intently at those times, even if it looks painful in the short term. You want to look at it now for where you can be 3 to 5 years from now plus.